Hello everyone, today I will be talking about the intuition behind the welfare analysis. So let's first review what the consumer surplus and the producer surplus is. Let's look at the diagram. In this triangle, we can see that it is consumer surplus. Why? Because at the equilibrium, we are actually paying price P1 and demanding quantity of Q1. But at a smaller quantity, the consumer is willing to pay a much higher price. Like for example, here it's like P2 and all the way down to P1. So these are the actual money that the consumers are willing to pay if they were not offered this P1 price. So this whole triangle is actually the benefits reaped by the consumers only having to pay price P1. So this is a consumer surplus. And also, we can see that the blue triangle down here is the producer's surplus. We can use basically the same logic. The producers are willing to produce a really small amount of quantity at this price P3, and they will be willing to supply about Q3 here. But they will still be supplying at this lower price. However, now at the equilibrium quantity, they are able to supply quantity Q1 while keeping the price at a higher price P1. So these are actually the total benefits reaped by the producers by producing at the P1 price. So after this review, probably it becomes clear for you like what the consumer surplus and producer surplus is. And if we add these two triangles, these are the total welfares of the society, which is the social welfare. It's the total welfare get by both consumers and producers. So now I'm going to offer you an alternative explanation to help you understand what consumer surplus and producer surplus are. Here on the right hand side, you can see the formula outlined by myself. Here is the producer surplus, numerically speaking, can be represented by the total revenue minus variable costs. The total revenue is actually these rectangle outlined by the black line, because it's basically the price times the quantity is the total revenue minus the variable costs. Because I would like to remind you that the supply curve is actually the same as the marginal cost curve, because it's represent how much it will cost for the firm to produce an extra unit of output. So the variable cost will simply just be the triangle underlying the supply curve, which is a shaded area. So if we subtract the whole rectangle by these little triangle, we can get the producer surplus, which is exactly the producer surplus, and it's represented by total revenue minus variable costs. So, and what does that mean? Actually, we can simplify that to the equation down here, because total revenue is essentially the fixed costs plus variable costs plus profit. So if we subtract the fixed costs plus variable costs plus profits, subtracted from the variable costs, we can actually see that it is actually equal to the fixed costs plus the profit. So how do we actually understand the producer surplus in terms of fixed costs and profits? It's actually pretty simple, because like what will the producer do with the extra revenue or extra surplus they received? One thing they're gonna do is they're gonna use these cash to actually cover up the fixed costs, and also the rest of it they will just allocate it to be profit for themselves. So it's actually quite intuitive for you to understand producer surplus in terms of the fixed costs and the profit. So here is a simpler diagram illustrating the same concept that I have already told you. The supply curve is equal to the marginal cost curve, and the symbol pi usually denotes profit. In this case, it denotes profit as well. So here we can see that that's the supply curve, and here is the price, which means the yellow triangle would be our producer surplus, which is exactly the total fixed cost plus the profit. And finally, let's move on to the international trade and how do we do the same welfare analysis. How do we apply the same welfare analysis to international trade scenarios? So here, let's see what's the initial condition. So let's say that initially we are actually allowing the foreign firms to enter the market freely. So our supply curve will first be initially, let's change this color to here, this portion, and then it will flatters out because there are a lot of foreign firms entering and will keep the price low at this low initial price. I might like change the color to make it clear. It's this line will be the supply curve under free trade. That will be the supply curve. Initially, it will follow the domestic portions, and then at like the foreign firms will drive the price down and not allowing the cost or the supply curve to go up. So under this case, we can see that first let's look at the producer surplus, because this is a price curve, and it should be producer surplus should be the area between the price and the quantity supply, which is exactly this small green triangle will be the producer surplus, because the black line is the supply curve and the price line is a horizontal line, which is basically overlaps with most part of the supply curve. So this small green triangle is the producer surplus. And let's look at what the consumer will get. Actually, consumer is pretty happy because the consumers, their preference hasn't changed. So the demand curve stays at this blue line, and just by following the same logic, above the price line, which is this black line, and below the demand curve will be our consumer surplus. So this whole area under this curve will be this total area. A plus B plus C will be the consumer surplus. So the total welfare will be this gray shaped weird triangle, or not really triangle because it's a curve. This area plus the green area will be the total welfare. So now let's look at the situation without trade. Let's see. So without free trade, the domestic suppliers will be the only suppliers or only player in the market, which had the supply curve of this black line, to make it clear. And also the demand curve doesn't change, so it remains on the blue line as well. So in that case, the price line is actually this green line. So let's look at how much surplus they will get. So first of all, we can see that the suppliers can actually get a producer surplus much larger than the green triangle than they get under free trade. It gives them the extra portion, which is denoted by B. So this whole area will be the new producer surplus. In a similar way, we can identify the new consumer surplus, which is the area under the demand curve and above the price line, which is this portion. So it's A plus B plus this original triangle will be the total welfare gained by both the producers and consumers. So notice how that gray area, the area C over here, is lost. These whole areas, actually the area lost under this trade. So we actually call that deadweight loss. Is the benefits that no one is able to reap, both the consumers, the producers, or the government. So these areas are simply lost under the restrictions of the trade. So that's basically it. Hope you guys enjoy, and thank you very much.